Okay, in the second video, we'll talk a little bit more about common stocks in general, and then we'll move into the valuation phase of this particular chapter and set of videos. So let's talk about issuing stock and how that happens. Most companies really don't have a person or a department, if you will, as part of the corporation that works in the stock market enough to understand the process, the current market price, etc. It's a very specialized sets of skills and knowledge, again, that most corporations don't have on board. So when companies want to go public, they usually need some help. They need to go do some outsourcing to get this done. So when companies initially go public, if you will, the idea is to sometimes just get some more money or get some money to the founding fathers of the company, but sometimes it is used for expansion as well. Now, where do we go to get this money? Well, it kind of depends on the size of the corporation itself before it becomes a publicly traded corporation. So venture capital really refers to privately raised external equity, right? So this typically, we talk about venture capital, you're talking about very early stage companies, right? Just becoming publicly traded. And there's two brands of these, if you will. We have venture capitalists, right? These provide a lot of capital, right? A lot of money for the markets, right? They are typically formal businesses. This is their job. Now, their idea, though, is that they're going to invest some money, but they're also going to have some very explicit details about how the company is ultimately going to be run and how they ultimately will exit the company. What will be the strategy for ending this relationship? Angel capitalists, right, are usually wealthier individuals, right? And they don't really want to operate as a business, but they want to invest. So frequently these guys act more like silent partners, if you will, where they definitely have some set structure, but they typically don't want to be involved with actually running the company itself. So again, when a company wants to sell stock, it does this, and we've talked about this before, in what's called the primary market. And there are three ways that this can happen. A public offering is where it offers, obviously, to the general public. We've already talked about a rights offering, where when a company issues new shares, it may have to offer these initially to existing shareholders. And then there also is what's something called private placement. And this is where, we'll identify a few investors or a group of investors, and we'll offer this to them directly. Now, that sounds like a good deal for them. However, there are some very strict guidelines on what they can do with these securities after they've purchased them. So it's a pretty structured and regulated activity after the actual sale of the security. So let's first start talking initially about what's referred to as an initial public offering. Company just wants to go public. It currently is not public, so shares do not trade. So it could be a corporation, just private, or it could be a partnership that now wants to go into the corporate world. But one of these, part of this reason, obviously, or the thing that they're going to have to do, is they're going to have somebody give them some assistance. Somebody's going to have to help them. And that entity that's used is something referred to as an investment banker. This is just a financial intermediary. They act like a middleman, if you will, for the distribution of shares. So let's think about why we're doing this. The company needs to raise $500 million. They could do that on their own, but they are going to have to find enough people to gather that $500 million. So by issuing the shares, they can have better luck in actually getting the money they need. So remember, they need this $500 million. So the role of the investment banker under what's referred to as underwriting is they're going to take the risk at distributing these shares. So essentially what they do is, one of the ways is they'll actually give the company its $500 million. So the company now has no risk of not getting the money it needs, but now the underwriter, the investment banker, now has the risk of getting rid of all of those shares. So it's a kind of a risky arrangement. And of course, investment bankers get paid very well for what they're doing. And because they're taking these risks, they're also very involved in the structure of initial public offerings and issuing shares. So they're going to help with advice of the kind of security. If it's a bond, it's the coupon rate. If it's a if it's a stock, it's the price that they'll be offering. So they're very involved in the advice and then the actual distribution of shares. So to kind of get away from that now, let's talk about some of the theory, some of the background in common stock valuation. We've used this term valuation a couple of times. We want to determine the value, the worth, what you'd be willing to pay to buy this asset. And again, once you have that number, we can compare that to the current stock price, and we can decide whether to buy or sell the shares, right? So again, no matter what our strategy is, whether it's speculative or whether it's buying and holding or whatever, right? We need to understand what the value is. And what makes the world go round is each of us as an individual investor, we're all going to have our own idea of what we think the value is. So one of the theories that helps us understand prices in general is something called market efficiency. Now, market efficiency basically states that the information that's available to investors is in the stock price. So rational buyers and sellers are going to use their assessment of risk and return to determine value. And in competitive markets, they're going to trade based on their analysis. And that trade is what drives the supply and demand mechanism to determine the market value. Now, because information flows fairly easily, stock prices are going to change, and sometimes they change a lot. So the idea of information coming to the public, it being analyzed, and ending up in the stock price is what's referred to as market efficiency. That is, information is in the stock price. So the efficient market hypothesis talks about the behavior of a stock in a perfect market. Essentially, it states securities are in equilibrium. Security prices reflect all information available, and when new information comes out, they are going to react quickly and the way you think they would move. So good information will make the stock price move in a positive direction, and it's going to happen very quickly. And this is because we assume then that stocks are fully and fairly priced. So if that's true, then investors don't need to spend a lot of time looking for mispriced securities. Now, this kind of flies in the face of what you think about investing, right? You're always looking for something that may not be appropriately priced. So the idea or the question in the end is this market, is it a perfect capital market? Is it perfectly efficient that information gets into a price and it gets there very quickly? And the answer is there are some mixed results on exactly how efficient the market is. So there still may be room for analysis in order to find things that are mispriced. Now, there's a growing body of research that kind of flies in the face of this efficient market idea. And it says really investor behavior is really what drives stock price, right? So the idea of behavioral finance is that pricing and decision making is a combination of both fundamental kinds of analysis, but it also is heavily influenced by the psychology of the investor. And that, in the end, is one of the newer branches, if you will, of finance that is trying to explain why stock prices do and move the way they are moving. So let's get into the actual valuation piece, right? The value of any asset is the present value of all future cash flows. So we're going to assume that the present value of a stock is the present value of all of its future cash flows, that is its dividends, to infinity, because a stock's going to be around to, we assume it has an infinite life. So how does this boil down into a formula? Here you can see these are all time value formulas, present value formulas of the dividends from the end of this year to infinity. So the first model we want to look at is something referred to as the constant growth model. And it assumes that the growth rate of dividends, right, is constant to infinity. So if you want to know the dividend at the end of this year, you take the current dividend and you multiply it by a future value factor for 1 year. What's the dividend going to be in 2 years? It's today's dividend times the time value, the future value formula that ends in 2 years. But what doesn't change is G. The only thing that's changing is time. Now what we find is because this is a constant growth model, that is, we assume G is constant, and that it lasts to infinity, this formula simplifies to this formula. So the Gordon model is the reference to this bottom formula, says if you want to find the value of the stock, you need to know three things. D0 is the dividend that was paid today. R sub S is the required rate of return for stock. In one of the chapters on risk, there is a formula called the security market line formula that can help us solve for this required return. And G is the growth rate of future dividends. So we only need to know three things. So there is a worksheet. It's referred to as the stock valuation dividend model worksheet, where you can calculate this number. And I also include the formula here for us. But here we have this stock. It's a textile producer. The dividend is expected to be $3 per share to infinity indefinitely, and its required return is 15%. So what is the stock's value? So if we put it in a formula, the dividend, next year's dividend is $3, right? This is a stock that has zero growth. So it's today's dividend times 1 plus 0 divided by 15%. So the value of this stock, when you plug it into our formula, you'll notice on the right-hand side here, we have a cell for D0. You need to know what D0 is. So we plug in $3 for D0. Up above here, you have the place to insert K sub S or R sub S, Depending on the textbook you have, those numbers are interchangeable. 15%, and D1 in this case is $3 times 1 plus 0. So this stock has a value of $20. Now, if this stock was trading for $19, would you pay $19 to get 20? And of course you would. If you paid $19, you actually would earn 15.78%, and you only required 15%. So if we expand this a little bit, the most recent dividend was $2.65, and dividends have grown historically at 5%. The required return on the stock is 20%, and it's selling for $15. What is the value of this stock? Again, plugging our numbers in, here's D0, plug in the growth rate and the required return. That's $2.78 is next year's dividend. Divide that by the 20% minus 5. This stock would be worth $18.55. Again, if the current stock price was $15, would you pay $15 to get 18? And of course you would. And if you did, you'd actually earn 23.5%, and we only required 20%. So that's the brief introduction into valuation. We'll talk about some complications and some additional points about valuing and maybe a few other techniques in another video.